What's going on, ladies and gentlemen? It's your boy Sal in the building right now, and today I want to talk about the difference between simple and exponential moving averages. So we're going to go to school a little bit today, and on the screen right now I have Apple, ticker AAPL. It was a very exciting day to trade Apple today. If you were in the black box stocks community room, there was a lot of money made on Apple today on this incredible crossover that we saw happen if you use a moving average crossover strategy. Now, what a lot of people get hung up on, and I have in the past, is the difference between an SMA and an exponential moving average, or an EMA. We are going to learn the difference between both and the sensitivities that show up within these trading platforms and how these differences can lead to successful and unsuccessful situations in your trading. So let's go ahead and take a look. Right now on the screen, I have Apple with today's price action, June the 12th, on a 1 minute time frame using a simple moving average of 10 and 25. Now, if we look at what we see here today, we'll notice that the 10 moving average started the day off here. This is 9:30. Started the day off advancing, but then eventually did come underneath the 25 moving average, giving a sell signal there at around 10 o'clock. All right. If you zoom in a little bit, you can probably see it, but it gives it exactly down there about 10 o'clock. That's when we get that sell signal on Apple. Now, I'm going to show you in the platform Interactive Brokers, which is what I use for my trading. So let's go ahead and pull up Interactive Brokers. Brief moment. All right, so here's Interactive Brokers chart. Again, this is Apple using a 1 minute time frame. I'm going to add in the study, and this time what I want you to do is notice where we come in. Now, I've already preset this is the 10-25 moving average. Now, what's great about Interactive Brokers is that they actually will give you the signal straight on the screen. So you'll be able to follow directly as the crossover happens. So unlike, TradingView or some of the other platforms where you're not notified, you actually have to visually look to see the line has crossed over. Interactive Brokers will give you the signal right on the screen. And these are not repainting. So as soon as it's up there for good. So in this situation, using an EMA, right? An EMA, we get the signal at exactly 10:12, a difference of over 12 minutes on an EMA and an SMA. So the EMA got us 12 minutes later. Now, you may say 12 minutes is not a lot, but ladies and gentlemen, if you have a situation where you are day trading on a Friday like today is, and you have this position that, let's say the, 345 put in Apple expiring today, 12 minutes is, that's a big difference on whether or not you're going to stay in the trade, whether you go in on a simple moving average strategy or an EMA, right? The 12 minutes, that's a long time when we're talking about intraday trading, to be in a position for 12 minutes and not make any money, right? Let's go back to trading view screen now, because I really want you to, recognize that. Let's go back to trading view. All right. So we're back here at trading view. So yeah, imagine being in this for 12 minutes until you started making money. Now, granted, you may be patient enough to wait that 12 minutes, but that's a lot of delta on a same day expiration that may be, floating away and really tempting you to sell, right? Really tempting you to sell, possibly closing a position that you would be able to eventually make a lot of money on, but you wouldn't have made any money on it because you weren't patient enough to stay in the trade, not because it was your fault, but because you were using a moving average strategy, an SMA strategy that wasn't sensitive enough to the time frame, right? That wasn't sensitive enough to the time frame. Now, let's go and get a little bit of education here on why that is. So I'm going to go to Investopedia. We're already zoomed in a little bit. So let's kind of learn here. And this is understanding exponential moving averages versus simple moving averages. So they give a little bit of introduction here, but let's get into the meat and potatoes of it. And it says there are differences between the two measurements. The primary difference between an EMA and SMA is the sensitivity of each one that shows to changes in the data used in its calculation. A simple moving average calculates the average of price data, while an EMA gives more weight to current data, right? The newest price data will impact the moving average more, with older price data having lesser impact. Now, that makes so much sense because that tells us right there that if we're a swing trader, right, whether it be weekly or monthly or, any kind of longer time frame or even daily, we probably don't want what happened on Wednesday at 2 o'clock to maybe affect what we're seeing over a weekly time frame. So that's why on those higher time frames, a simple moving average strategy would work best for us. But now we've learned by looking at the chart that an EMA is by far the best selection for intraday trading. Since EMAs place a higher weighting on recent data than older data, they are more reactive to latest price changes than SMAs are, which makes the results from EMAs more timely and explains why the EMA is the preferred average among many traders. All right. So, ladies and gentlemen, I'll leave this article in the description, but as you can see here from just a basic example, right, the difference between either closing a trade for a loss or sitting in a trade for an incredible gain, which many of us got today on Apple, was the difference between having a simple moving average strategy and an exponential moving average strategy. Tongue twisting myself here. So it's your boy Sal. I really hope you took something out of this because it's definitely telling. Definitely telling. And again, any comments, questions, let me know. Until next time, take care. Trade well.